Alright, well hello again everyone and welcome out. This is Ankit from Maverick Currencies here, and in this strategy session we'll be going over time frame and volatility. So let's get down to it and take a look at this topic and kind of explore further. So one of the things we always talk at Maverick is that trade the markets in front of you, not your opinion. And one of the things that I was noticed between traders is that a lot of traders don't take into consideration the volatility as it fluctuates throughout the year. And it's very important to have a strategy to adjust to the market conditions. So if you go in the markets with one strategy, you realize that it's only going to work as long as you have the market environment. But as you look at the entire year, we go through periods where we have higher volatility, we have low volatility, we have a nice direction, we got range bound conditions. So everything changes throughout the year. But going in with one strategy is like going to play golf with just one club. You might do well for that one or two holes, but then after that, as the difficulty changes and the scenario changes, the environment changes, you might struggle. And that's just where you have to use that and be in the leading position than using in the lagging situation, where by the time you recognize things have changed and you try to change your strategy, and next thing you know, market changes again. So it's important to keep in mind and use the right time frame for the right market. So the time frames, we can look into two different time frames: higher time frame and lower time frames. So in the higher time frame, like longer term charts, like a 4-hour or even a daily chart, so they do a really good job at recognizing trade momentum, but it works around really, really well with low volatility environments. So when we have a direction with low volatility, this higher time frame works the best. But as soon as the scenario shifts, when suddenly we're getting a lot of volatility, but not a whole lot of direction, that's where lower time frame actually works out the best, because it gives you a more clear indication of when those turns happen intraday, and you can actually take advantage of that. And usually the lower time frame we consider is about 15-minute to an hourly chart. So between those two time frames, the strategy again would be decided based on what kind of volatility that we are seeing in the market. So when you're trying to select a strategy, you're adjusting your time frame, and you also need to make sure that you're using appropriate strategy. So for example, the reversal patterns on a shorter time frame works the best, or managing stops on a shorter term time frame. But on the other hand, I can be looking at a daily chart or longer term charts for a whole lot of different ways of trading it. But our job is to make sure that we're using the right tools, we're using the right strategy for it. One of the tools that we discussed in our last session was average true range. One of the most commonly used tool, or the indicator that I like to use, is just to kind of measure volatility. And as the market will change throughout the time, what we are trying to do is making sure that we are adjusting to the market conditions and the changes to the volatility period. So if you're seeing a lot of volatility on a daily chart, maybe it's a time to maybe use a lower time frame as that volatility increases. And back in 2020, with the COVID time hits, that was a good example where the ranges got so wide on a daily chart that it almost became impossible. So let's just say if you only trade on a daily chart, now that's not a great environment for you. But on the other hand, if you are adjusting your strategy to a lower time frame, just so you can actually take advantage of it, now you're doing much better because you're using the right strategy that fits the right market environment. So we can jump into the charting software. We can take a look at TradingView, and you can use the ATR to kind of look at the volatilities across the time frames. As you can see, there's different scenarios that takes place. Sometimes we get a direction and we get low volatility. Those are great for higher time frames. A good example would be just over here, like in a currency pair like Aussie Kiwi. You can see where the rise is happening while the volatility is falling. Now this is a perfect time frame to use on a higher time frame. Now suddenly when that changes and now you're getting a bunch of volatility, now the daily chart doesn't look as good to trade. maybe that's where shifting into a shorter term time frame like a 4-hour chart or an hourly chart, the ATR will give you a different story, and your job is to making sure that you're using the right strategy for that time frame. We actually had this year we had a lot of currencies where the volatility really picked up. The Japanese yen is a good example. Now we can see the Japanese yen has been trading all sorts of ways. Early this year, we were sitting at a lot more lower volatility. And suddenly, we got a big drop. And we actually saw a bit of a pickup in volatility as well. But notice that when we got this drop, the volatility was dropping as well, which means that this was a perfect time frame to choose on a daily time frame. Now, after that, you can see the volatility has been all over the place. And suddenly, we are not getting a whole lot of direction or pushes. I mean, we are seeing a big drop in volatility, but not a whole lot of direction. This is again telling me maybe daily is not the right time frame to choose from. Let's go down to a 4-hour time frame. What's a 4-hour time frame is telling us? Well, it's just telling us that volatility is dropping and the price action is not going anywhere. So this is again an example where you might just go and say, well, this is not the right currency to trade for me at this moment. We could use the exact same scenario in the dollar basket, and you can see where you get these big advancements, and you have the volatility that's rising, and then you have periods where the price action is falling, but the volatility is actually staying steady. So the big contrast between a higher time frame and lower time frame is taking a look at that volatility, and if the volatility is higher, then again the opportunity is much better on a shorter term time frame. Now, going back to 2020 when we got this massive move in the markets, if you're trading on a daily chart, your candlesticks are so wide that the risk to reward ratio is pretty hard to determine. It's hard to get a good risk to reward ratio on a trade because you might be risking about 200 pips to make 200 pips. You see, like that range gets very wide. Now this is a good example on a daily chart. Now, to get the big direction, we got a volatility as well. So that means that this is pretty difficult to trade on the daily chart because the candlesticks, the size of these candles are massive. We are looking at this dollar CAD position, 144 down to 142. Now, that's about a 250 pip range just on that one single candle. I mean, we really, if you look at the price action lately, we are getting less than that just on that daily time frame. So this is what's telling you where it would have been better to trade on a shorter term time frame to spot the same opportunities, but you'll be able to spot them a lot quicker than waiting for these higher time frames to give you that confirmation. So in review, determine the holding period of your position. That's the first step I always ask. Before we jump on, before we decide, okay, I want to use this time frame. You have to figure out how long you want to hold a position for. So, for example, if I'm trading in the second half of the week and not really planning on holding a position over the weekend, now I need to make sure that I'm using the right time frame because my holding period is smaller. Now, in contrast, now let's just say it's an early part of the week. I have an entire week to let the position develop. Now I can use a bit of a higher time frame to decide. Okay, I can go with this time frame because I have that time for that position to develop. So always figure out how long you're gonna hold a position for, and then adjust the strategy based on the market conditions and then volatility. Keeping an eye on ATR, keeping an eye on just the market environment over overall volatility. At the end, trade the markets in front of you, and not the markets that you wanted to see, not the markets that you really enjoy trading in, because the markets will keep changing throughout the year, and it's important as a trader to keep up with the markets. And at last, when in doubt, I always say, stay out. Not everything will line up all the time, and that's always an indication where none of these things are matching up, and it's hard to really get hold of the markets. And that's a perfect scenario to stay out of the market. So hope you find this helpful. We'll be back with another concept. Till then, take care.